Today, folks, I'm going to reveal to you my 5 unique dividend stocks that are going to be the core focus into the latter half of this year for me after being so invested into growth stocks, whether we're talking Bitcoin, whether we're talking Tesla, Google, Facebook. I've been loading the boat to the point where I literally have now over $100,000 in those positions, and it's time to take a breath back, go back to my core fundamentals, and start scaling my dividend income. So in the clarity of my transparency, consider hitting that like button, folks, because we ain't talking you usual dividend stocks. We ain't talking you JP Morgans of the world. So I think you're going to relatively enjoy this, especially for the few particular reasons that I'm going to be core focusing these specific companies. So to kick this off here, folks, let's talk about Toronto Dominion Bank, a Canadian bank, and one that's on my radar because it's the only one I haven't scaled to a full position yet against my Canadian Imperial Bank or my Bank of Nova Scotia. Now, this company is currently paying a 3.72% dividend yield, an incredibly healthy PE, but the core reason that I want to talk about this bank and the Canadian banks in general is because I am expecting some pretty big dividend increases. Now, there's an article here that says Canadian banks poised for 13% dividend boost when regulators give it the okay. And just reading into this, Canada's 6 largest banks flush with capital after the pandemic failed to bring the extended wave of loan defaults like many of us were expecting, and it could boost their dividends by an average of 13% when regulators allow them to resume payout increases and still have room to buy back almost 2% of their shares. Now, this is really similar in the US. We're going into the pandemic out of a lot of fear of defaults and banks getting hit heavily with that. The Treasury here in Canada, the Federal Reserve down in the US, they said, hey guys, we're going to take a breath for a good year here. Let's see how this pans out before you guys go too crazy on handing out more capital. But I don't know why it makes so much sense at this point, and I'll explain why. But take a look. The last time TD increased its dividend was literally in the pandemic, March 08. They did a dividend increase of 6.76%, which was about half as much as they did in the year prior. And since then, no dividend increases whatsoever, even though TD's payout ratio is only 37.22%, and they actually hit record revenues this year. So that's something that I'm definitely looking forward to, and one that I may be buying soon or really early next year when I have more contribution limit to my TFSA. But let's take a look at another one. And I've talked about this one prior to Algonquin Power. This is a utility primarily focused on natural energy, but they have exposure to transmission lines, water utilities. They're into natural gas, and the stock has been trading down almost 12% year to date. Starting yield is 4.7%. PE is really reasonable on this sucker, and I'm pretty invested into this one just because they keep posting really great numbers. So I don't know how the stock is trading down so much. Maybe I'm missing something, but their adjusted earnings were 93%, an increase for the 3-month end on their second quarter financial reports. The dividend increased this year 10% over last year. The adjusted funds from operation were up 73%. Adjusted EBITDA was up almost 40%. These numbers are what exactly we want to see. And even in recent news filings, guys, they claim that by 2023, 75% of their power production will be coming from natural energy resources. And we can see even here in the last month that Liberty and JP Morgan Chase collaborated on a 108 megawatt wind project in Illinois. There's just endless good news with this company, and it's been pretty resilient from a balance sheet standpoint. So I will definitely probably be picking up some more of that with some dividends. Now, in the continued conversation behind some REITs here, and I promise you I'm going to move into some really other different sectors of the market shortly, because I know I talk about these ones a lot particularly, but Granite Real Estate Investment Trust, guys, paying a 3.32% dividend yield, just starting to pull back slightly, is extremely reminiscent of a company that you might be familiar with called Stag Industrial. These charts almost line up directly, and they correlate in ways that are utterly fascinating, both being in logistics and industrial warehousing. If we take a look at the year to date, however, guys, Granite's only up 17.9%. Stag is up 31%. But when we look at the 5-year chart, Granite Real Estate Investment Trust is outperforming Stag. Now, these companies both have such similar balance sheets, tenant basis, and they're growing like monsters, gobbling up tenants like Amazon. They can't keep up with their own scale. Granite, however, is about 30% leveraged into a company called Magna for their distribution and warehousing, whereas Stag, their largest tenant is Amazon, which only makes up 3 or 4% of their portfolio. And it's a little bit more diversified, and I think Stag is a little bit more resilient in my opinion. But because I like the Canadian aspect of Granite Real Estate and the fact that Granite is more globally diversified, I think these two companies tandem each other very well in my portfolio. So this is a new one that I've been scaling recently, as many of you may be aware, and it's kind of easy to imagine why these company stocks are flying so much when you just take a look at the rental revenue increasing, going from 159 million to 189 million this year for the 6 month, and a 30 million increase, guys. And when you just scroll down, take a look at the net income increase. I mean, for the 6 month end, going from 157 million to 547 million. Probably a lot of that came from write-downs and stuff, but I always just pay attention to the net rental revenue. And if this company keeps up this pace, you're paying a premium to get into it, but it's totally worth it in my opinion. And when we just take a look at the dividends, guys, also another one likely to be increasing the dividends soon. Now, it's nice to catch these ones on dips. They're trading on dips, might be a good buying opportunity. That's why I'm going to continue picking Granite up. Now, Medical Property Trust. I don't got to explain this one very thoroughly. This is primarily focused, obviously, on hospitals all around the world, primarily focused in the U.S., obviously, and has also been trading down roughly year to date, guys. It's down 6.3% with a starting yield of 5.7%. This thing is a stable dividend payer. Most dividend investors looking to reach their financial independence will be buying companies just like this because their lease structure goes out for 10 years. We're talking about hospitals, guys. Hospitals. I mean, it's crazy to think that in the middle of a pandemic where this should be the most valued thing on the planet, it's trading down still, which is, it's not even close to its all-time highs. And yet we did have a dividend increase kind of in the third month of this year that jumped 3.7%. This one isn't world renowned for dividend increases, but when we're talking about getting cash flow today, I mean, this thing's stable, the yield's wonderful, the balance sheet's great, the business model's great. So this is one that I'll probably continue to pick up with dividend income over the last 3 months of this year, guys. So moving into one that's a little bit segued. Haven't talked about this sucker in a while, but let's just comment on Telus Corporation here real quick, because this is a Canadian favorite of mine compared to any telecom. It's the only telecom I own. I haven't scaled it just yet. I got about 10,000 sitting in this company paying a 4.58% yield. I use this company basically to pay my phone bill every month. It's really nice that you can own such a little bit of Telus or a little bit of telecom companies because the yields are so high that it can immediately start covering your internet, your phone bill, or any bills that are correlated to you actually utilizing their services. So right now I love this guy with a passion, and I will likely, with my own personal income from my new job, be scaling this in my regular brokerage account. But yeah, Telus, guys, they've been really trucking along. And one of my favorite things about them, because when I talk about telecom, when I talk about utilities, when I talk about housing and real estate, I'm always talking about it from a Canadian, basically, economic and population growth standpoint and GDP growth. And that's exactly what Telus does in their economic statements, because they actually show you the economic growth in Canada and how it has been scaling from different aspects of the industries. Like unemployment is down massively this year, guys. When you take a look at housing is up massively on basis points this year. But when we take a look at this, guys, because Canada is one of the fastest growing first world nations, I'm just really great with infrastructure here, because I mean, we have housing shortage, we have just a few telecom companies, a few banking companies, and all this population density growth is just piling into that infrastructure, giving us a really healthy growth rate. And I mean, when we just take a look, they're experiencing their operating revenues and other income have been growing by about 9.6%, the largest coming from equipment, and basically their equipment services, I don't want to say services, their equipment is up 30% in sales, and their services are up 8.7% in sales, giving us this nice moderate growth rate. And again, we're not talking like tech here growing at a 20% clip every year, but for good, stable dividend income from a telecom company, guys, that has even increased it over the last few months, this is one that I just love to own. I mean, it's just a great Canadian telecom compared to Bell, compared to Rogers. There's more stability in the stock. Management's been doing a great job on telehealth, a new part of their business. They're doing great with security, and of course, the fundamental reality of their 5G infrastructure they just built out and started investing into. I think it was early last year or maybe this year. I can't remember off the top of my head. But yeah, these are the 5 stocks that are going to be the core focus going into the latter half of this year for me, guys. I'm already at about 800 or 8,300 in annual dividends before taxes or anything else comes into play. And a lot of that comes from my registered retirement accounts. But now that, I've been focusing on my corporate account being a growth account, and I'm kind of at this pace now where I'm from a percentage standpoint, super happy with that, guys. But I want to get my dividends over 10,000 annually, which means I need about another $1,700 in dividends. If you you know, you can get a 4 or 5% yield. Roughly, you're going to be looking to invest about another $30,000-$40,000 to get me to that scale, which might not happen obviously in the latter half of this year, but I think by maybe mid next year, we'll be well over those goals. Or heck, maybe Bitcoin flies through the roof. I take a little bit of profit here and there off any of these companies to continue to just formulate that nice balance in my portfolio. But at this point, I want to pass the question off to you. What dividend stocks interest you right now for your financial independence to perhaps one day retire early? Stay cool, stay awesome, and I look forward to catching you in the next one.